Welcome again to another edition of Back and Forth, the podcast where we take a topic and we talk both sides of it. As we know about things in the financial industry, they are not always one direction, one way, always the way it is correct for everybody. So we want to make sure we dissect those and talk about where it can be beneficial on both sides, maybe outcomes that could be one way or another. And so today, that's going to be kind of the direction we go in. We're going to talk about the election, which I know for a lot of people that has been very low on the priority list with everything that's been going on in our society. But we still have an election coming up, and although it's been a not so normal year, no election year is really normal if we look back in history. And so what we want to do is look at some of the data. Obviously, we can't predict perfectly what's going to happen, but we are going to look at some of that data and try to give some input on what we could think would happen with this election year. Because, again, there's data that I think supports both sides,
right,
as we've been looking at it, especially, with all of the things that have happened this year. And as we look back at historical events, we want to make sure that we're seeing this from both situations, but also seeing the big picture of what impact market events and market results need to have on the way that we invest our money, regardless of the outcome. So as we look at this, again, want to be in a position to understand election years. The two sides that we're looking at today are, is the election this year going to cause the markets to have a negative impact, or is the election going to have a positive impact on market returns? And so I'm going to take the negative approach today. Zach will be the Mr. Positive. And again, to introduce Zach, my name is John Vandergriff. For those that don't know me, Zach Hill is, our operations team lead, portfolio management guru, owner of Remedy Coffee. So downtown, if you're a coffee man, or lady, go there. They don't discriminate. If you love coffee, go get it there. So anyway, as we look at election years, and again, Zach will spend more time on this, you look at this from the aspect of, generally speaking, election years are positive when it comes to market returns. However, we have had 4 instances when the markets returned a negative result in an election year. And what's interesting is all 4 of those events had larger impacts outside of the election that were impacting the financial results of the market. So it wasn't that, oh gosh, the people hate who got elected, because generally speaking, they probably wouldn't have got elected. It's a popular vote in most systems. But as we look at this, those things that are happening outside of the world of politics can have a tremendous impact, not only on the financial ramifications, but also how history looks back on some of these election years. So the 4 times that we had a negative result in the presidential election, as far as that coinciding with the stock market negative result, the election was what it was. Years 1932, 1940, 2000, and 2008. So again, as we look back at history, what things were happening during that cycle. 1932, obviously we were in the midst of a Great Depression in our country that started in the year 1929. And then 1940, we were seeing still some effects of that depression, but also everyone else in the world was going through a world war that we had not yet gone into, but we're feeling lots of pressure and effects from that as a society, and obviously, in terms of global relations and things of that time. And then as we get into more recent past and things that most of us remember, 2000 was when we had the dot-com bubble burst, and that was when obviously the election happened before 2000 was up. And then we saw 2008. The election happened shortly after Lehman Brothers had failed and started basically the great financial recession that we had in 2008. That's kind of 07 to 09 in its lifetime, But so as we look at that, bigger impacts outside of it. And so as we look at this year, could COVID-19, coronavirus, this pandemic be that kind of historical event that causes that type of negative market reaction, regardless of who wins the election? Could that be just so great of a mountain to climb, or wave to overcome, whatever terminology you want to use there? Is that going to be the thing that really derails the market that has nothing to do with the election.
Yeah, and it's interesting that you mentioned Lehman Brothers, because when you look back, 2008 is the most recent one, so we can kind of remember that a little bit better. But that was in September of 2008, like you said. That's 2 months before the election hits in November. And so right now we're seeing, as we sit here in the middle of July, we still haven't seen COVID cases peak in the U.S. So are we going to look back on this in 10 years and say, well, they peaked 2 months before the election, and then in retrospect it looks so obvious why markets were down in 2008, but right now it's a little bit, we see, okay, the election, we don't know how markets are going to respond to the election. We don't know how they're going to respond to the COVID-19 cases. We just really don't know. There's a lot of uncertainty around that, and so we have talked about this before, but if there's one thing markets hate, it is uncertainty.
Yeah, and so again, with so much uncertainty, not just with the pandemic, but also with elections, and I think there's no clear-cut answer as far as who's just running away with the race right now. I think it's, there's definitely a lot of people in both camps that feel like they're a very good position to, win the election, and so there's not a clear-cut favorite, which, again, that uncertainty is going to probably lead to more volatility. And so the question is, will that volatility kind of compound the impacts of things outside of it, or will the economic data and the response back from the pandemic overwhelm the market volatility that comes from the election turmoil? Because I think that's going to be the key, and, we had talked some in our office about, quarterly reviewing, and Zach had done a great job reviewing that. And what we saw in the first quarter was terrible market performance with very strong economic indicators still. Mm-hmm. Second quarter was tremendous market performance with poor economic indicators. The third quarter is really maybe, both up or both down, depending on kind of how different things turn. So like you said, I think a lot of that uncertainty could lead us into a negative situation regardless of what happens in the election. Again, it doesn't matter Democrat, Republican. We could see a situation where we've got a negative result at the end of the year no matter who gets elected. And so that's the thing that we have to be aware of with things like the stock market. We've got to be in a position where we understand that negative results are happening, even though they're not statistically the overwhelming part of what happens, because even like you and I have talked, markets go up more than they go down. Yep. But you've got to invest in the market, not worried about it going down with the portion of money that you want to have there. You've got to expose it properly, regardless of what the outcome is at the election or by the end of the year. This needs to be longer than a 6-month focus for you in the stock market. It needs to be a 10-year minimum probably position that you want to hold on to.
And the market changes. So we've seen this changes so rapidly right now. Like you said, first quarter we were in a bear market. Second quarter we were up. We reversed almost all of the gain or losses of Q1 and Q2. It's happening. And if you want to speak about something election specific, in 2016, the night that we got the election results and Donald Trump surprisingly won, it surprised most people. Markets were down 5% that next day, and then the rest of the quarter rallied. I mean, it was a huge rally in Q4 of 2016 after he got elected. But the day of, we were down 5% that night. I mean, as soon as it happened. So markets are reacting so quickly that if you don't have a longer-term focus in mind to wade through all of that uncertainty and volatility, that you really aren't going to know what to do, because markets don't know what to do. So you really have to have that longer-term time frame.
Yeah, and so as we look at this, that's why. As we look at it, I think, again, depending on how pessimistic you are, we could see a very negative result that has nothing to do with the election part of it, or it could have everything to do with it, depending on how that unfolds. The key here is just making sure that if we're going to place money in the market, we're okay with either direction, at the end of the day. It's not ideal to ever lose money, but you have to be willing to have that type of risk tolerance. Otherwise, you don't need to play that game. You need to find somewhere else to place that money. So, as we look at that, we want to make sure we cover all our bases. So that covers kind of the negative possibilities. Zach, as we return, is going to cover the positive possibilities that are associated with election years, traditionally speaking, and what that could mean for this year. So come back with us in just a second, back with Blue Ridge Wealth and back and forth after this break.
In 1916, President Wilson passed a stimulus package that paid for the American efforts to end World War I. In 1933, President Roosevelt's New Deal ended the Great Depression.
This is about to pass legislation that will greatly ease the mortgage distress among the farmers and homeowners of the nation.
In 2020, President Trump's $2 trillion stimulus package is helping end the COVID-19 pandemic.
The single biggest economic relief package in American history.
Do you know what all these acts have in common? Taxes went up. Yes, they solved crises, but Americans paid for them with increased income taxes soon after. Move your money out of taxable accounts now before it's too late. At Blue Ridge Wealth Planners, we create comprehensive plans that include strategic movements between taxable and non-taxable accounts. To schedule your free virtual consultation or phone call with a wealth planner, visit us at planforeverything.com. That's planforeverything.com. Let us plan for everything so you don't have to.
All right, welcome back from the break. Back and forth with Blue Ridge Wealth. My name is John. This is Zach. I hit the negative sides of what could happen in negative markets of election years. Zach is going to show us why, statistically speaking, a positive result in the market is more likely with the elections. And so I'll let him get into kind of the nuts and bolts and data with that. So take it away, Zach.
Yeah. Well, you already hit one of the biggest points of all of this is that the S&P most of the time is up on an annual basis. We always know in retrospect why that is. And so we mentioned there's just a lot of uncertainty with the economy and with the election and everything. But in retrospect, we can look at it and say, I think an easy, quick rule of thumb, it's not exact, but is the S&P is generally up on an annual basis 75% of the time and down 25% of the time.
Right.
So you've got a pretty good, just blanket statement, markets are generally up, especially over the long term.
So you can almost apply that to like the election.
Yeah, exactly.
Results.
Exactly. So that's, I think that is a foundation for everything, we can base our knowledge on, is that typically markets go up over time. If the election, regardless of how it turns out, there's going to be volatility. We know that. That's just a given in any year. But we also know that generally markets are up. The second thing that I think is pretty interesting is in 2016, Charles Schwab did a study on performance immediately following an election and the years after. And they found that since 1950, the second year of a president's term, the average market gains are 7%. Third year, their average are 16%, and then the fourth year, it's back down to 6.6 average return.
Yeah.
So is that generally there is the first year of the year of the election is 6.5%, and then it's all higher than that after that. So what we're looking at is there might be some short-term volatility, but if you're in it, like we said, have a longer-term focus, you are eventually, historically at least, you've made back your money in the next 2, 3, 4 years.
And some of that probably, kind of going down a little bit of a rabbit trail has to do with just the way that a lot of presidents try to organize their campaigns. Like if they're in their first term, they're trying to really get the job done in years 2 and 3 so that they can make that push for re-election and not shake things up too much in year 4, which is kind of reflected in that, statistic that you gave. So.
Yeah, and it's a really weird thing to talk about now in retrospect, but 2008 when Obama won, I believe he had a super majority, so he was able to get a lot done the first 2 years, and he was of his agenda, and he also took over after the markets had fallen quite a bit. So there's a lot of interesting things that you can see that happen and generally that have coincided, like you said, with those 4 years where the markets were down during an election year that I think were pretty interesting. Another thing that's it's an interesting stat. I'm not sure, what the takeaway is right now, but it's a pretty interesting stat, which is just the S&P was invented in the 1920s. So there was a study done, and they found that since 1928, the stock market has actually accurately predicted the winner of the election 87% of the time based on the prior 3 months data. And so what it found is that if the S&P 500 was higher in the 3 months following before the election, so we're talking August, September, October, in those 3 months, if it was higher, the incumbent party won, and if it was lower, the incumbent party lost. And so they found that out with 87% accuracy. That's pretty great. It's been right every single time since 1984. So that is something that is just a weird thing that we can look at and say, well, this is pretty interesting to follow. It's been wrong before, but it's been right most of the time. So what that would say is if markets are up, the incumbent party is going to win. If they're down, the incumbent party is going to lose.
So really, August is what we need to be looking.
Yeah.
So,
If we start in August and then look August, September, October, markets have been pretty good at predicting that.
Which, as you look at it, that's not a totally uncorrelated statistic.
No, not at all. Yeah.
Like you talked about, markets generally reflect a lot of people's confidence levels in what's happening, but also the lack of change that could happen. And as people approach that election, if they feel like that incumbent party is going to stay, then that means less change is going to happen, and they're more, I guess, forthcoming with money going back into the market instead of putting it on the sidelines. So,
and also, if markets are up and things in the economy are good, they're going to be less likely. There's a lot of people that participate and trade in the market, so there's a lot of people that are voting. So that also can reflect the emotions of the underlying participants in the market at times too. So things are positive, you don't want to change.
Right, and so that may impact the vote that you have more than anything else to just not rock the boat.
Yeah. And so the last stat that I have here that I also think is interesting is just from going back to what I said, where markets are generally up, is that the average stock market return, as we've said this before, and this isn't going to be exact either, but for the S&P 500, depending on what your start date is anywhere between 8 and 10% on an annualized basis. So you can think I'm going to get between 8 and 10% annually, historically, going back to 1928 for the S&P 500. So that's pretty interesting. The annual return for the stock market during an election year is, 11.2%. So it's right. I mean, that's right in that range. So, I mean, you add a percent onto it. So it's actually somewhat better sometimes. Yeah. But we're looking at, when you look at all this data and all these stats, you can kind of going back to where you started is, for the most part, it's generally pretty good. Mm-hmm. There's just a lot of historical times that we can look back on and say these 4 years were bad, but overall it's been pretty strong, pretty strong for the market, which follows the historical trend. And so it's not exactly the most exciting thing to say that markets are up right when they're up 11% and they're normally up 10%. And so we think that's statistically right in line with what we'd expect. And so, we can't tell, obviously nobody can tell if this year is going to be one of those historically significant years or not. It seems like it's going to be just from the first half, but we still have 6 months to go. Right. But looking back at this now, we can say, we just look at it and say, well, the only thing we know is to look at this data, and this data is pretty boring.
Yeah.
Which is good. Markets don't like volatility, and, if we can, have data that is like this, then I think that's a good thing.
And hit on, too, as a piece of that, I think you'd mentioned earlier in the day when we had that review of talking about the percentages if the incumbent wins versus the party change. Talk about that, because I think that's an interesting dynamic, because most people think, oh, if the incumbent wins, it's great, and if the party change happens, it's terrible, and the market's going to just collapse. And all this work that the previous regime had done is going to be for naught. So hit on that.
Yeah. I think this is the median return for markets, and this tracks the last 22 election cycles as of 2016. And so the average return, or the median return, so it's not the average, it's the median. The median return for incumbent parties winning the election was 11% that year, and the median return for the party change was 13.2%. Right. So that party change was actually higher, and like we said, that is interesting, because typically markets don't like change, but here's a point of change, and so maybe it's good. We saw that, like I mentioned, in 2016 there was a party change, but in that fourth quarter after the election, markets rallied like crazy. I mean, we had a big rally. So.
And I think, like you had mentioned earlier, that's not a huge separation between the two, but I think that is probably a surprising statistic for a lot of people, especially if they're just very partisan in the way that they view their life of, if what I know to be true changes, everything must change, and it must change for the negative. And it's one of those things where it's like, I think we get too self-involved with that demographic, and just if what we think about life changes, then everything's going to be terrible, and it's really not different either way,
Right.
And so it's one where, if Trump gets elected again and the market continues up, that could happen. If Biden gets elected, that doesn't mean it's going to go down,
Right.
in the way that some people, especially, here locally, think about it. So we've got to make sure that we do look at it from the historical context and say, there are things that we know about the stock market that don't change just because this is an election year.
Right.
It's generally up over a long period of time. You will make money, but that 25%, as you had talked about, that it goes down, it can really go down, and it can really impact things. And we've talked a lot. I know I say this to people a lot, but losses hurt you more than the gains help you. And so, that loss potential at the wrong time could be catastrophic, even though, generally speaking, that market's going to go back up for you. It's just the length of time that you have to wait. And like we said, that long-term perspective really needs to be the focus as you look at not only how you invest your money, but also not being so concerned with the short-term election that you put your cards too much in one direction or the other, and unfortunately get the negative impact of that. People don't ever – I don't think people ever put their money in the stock market with the hope that, I'd really love to be able to achieve a capital loss so that I can knock off the positive gain that I had on something else. There are some people that think that they have bad luck in that regard, but most people put money in the market hoping that it's going to give that positive return. And again, the numbers suggest over time that should happen. Right. But we got to kind of wait and see, with this election cycle, what makes it different. Is this pandemic a thing that impacts it, or is it a non-major event once things get kind of back to normal, and we see the impact of this election cycle, who wins, and then obviously how that rides out by the end of the year. So, I think – go ahead. If you,
No, I was just markets, stock markets. When you talk about this, it's they don't. Stock market doesn't have any emotion. We have emotion. Yeah. It doesn't care who's in the office as long as it gets the underlying economic results that it wants, and the companies produce earnings and they have profit. Then stock market will go up. They don't care. So it's unforgiving in that way, where we have, like we said, we have affiliations, we have biases, we have opinions and thoughts and emotions, and the markets don't at all. So having that longer term mindset and having that approach where that generally markets go up, but I may have to stay in it for a few years to achieve those results. This may be one of those 2008 election year scenarios, but having that mindset, because the market doesn't care about your portfolio, it cares about the overall economy. It doesn't care about who's in the White House, as long as that benefits the overall market performance. So.
Yeah, and I think that's interesting the way you said that, of the market has no emotion, yet we have a lot of emotion in how we react to it. And so, if just by a rule of thumb, if we handle the market the way the market acts, we will probably be in a much better position at the end of the day, because we're removing that emotion out and just looking at the facts of, the economic indicators look good. Everything that's driving this with supply and demand is causing this to generally trend up, and that will allow you to hopefully avoid some of the pitfalls that the average investor has, and be in a position to build that into a very important piece. Because again, I think sometimes can come across as very harsh on the market, as we look at retirement planning, but the market can be one of those things that is vital to helping that longevity of a person to not outlive their money and keep up with those inflationary increases, even though the market doesn't follow inflation per se. It's not a direct correlation, but over time, if you have something that generally grows, it's going to respond to a generally growing inflationary environment. So as we look at that, it is something that you do, but you've got to handle it with a certain level of care, with a certain level of lack of emotion, as you said, but also helping it find its proper place and fit in a retirement plan, I think, is key. regardless of this being 2020 election. So hopefully, you've learned some things today. You've seen a little bit of history. And the thing that you always have to take with a grain of salt is even though we've got historical indicators on both sides, these will not predict the future, okay?
Nope.
We'll find out in 2020 election in November whether you were right or I was right. But it's
I
not.
tell
because,
everybody I'm going to be wrong at some point, so don't.
Yeah, and I'm wrong all the time. So it's but again, as we look at this is another example of how both sides matter. Both sides help us make decisions, and so thank you for joining us on Back and Forth. We look forward to talking to you again on both sides of another topic.
Investment advisory services offered through Blue Ridge Wealth Planners, a registered investment advisor. Securities offered through Madison Avenue Securities, LLC, member FINRA, SIPC, MAS, and Blue Ridge Wealth Planners are not affiliated companies.